The labor markets proved a lot more resilient than some had anticipated. It is Wednesday, February the 11th, and this is Markets with Megan. If you like this podcast, subscribe, hit the alarm bell. You can share it with friends, family, or colleagues. But we're here today to break down the economic data, and this morning we received the non-farm payroll report for the month of January. Now, because of the government shutdown, it was delayed. Usually we get it on the first Friday of the month, but we received it on a Wednesday today. And the markets initially really liked this data. So let's dig into it. The U.S. non-farm payrolls, the change for January was an addition of 130,000 jobs. So this was much better than anticipated. We're looking at some data indicators, whether you look at the 3-month moving average of payrolls or you look at the unemployment rate, it looks like we might be trying to find a trough and maybe move a bit higher. Now, we also received the annual revisions for payroll additions and subtractions for the prior year. And we did actually have 1 million less jobs created, but you're seeing that might have been pushed prior to the most recent data. So the weakness was further behind us than was anticipated. And it does suggest that the Fed probably should have started cutting rates when they did. So that's good news from the inflation and then the confidence in the central bank. But what we're seeing now is that we're getting some green shoots here. That's what people say when you're getting these positive momentum. You've got the work week that rose. One of the indicators we look at is temporary workers. And if temporary workers are continuously being reduced, that means that's an indicator of leading weakness in the jobs market, because typically companies don't fire their full-time employees. They just don't hire as many temporary workers. So what we saw was temporary workers rose. That's actually the third consecutive month. Some of the other areas that saw pretty good job creation was in the private service producing jobs. So think of private education and health. That saw a pretty big uptick. And then professional and business services. Now, leisure and hospitality, they created 1,000 jobs for the month. So that's been slow. It's been weak. And that's been kind of like a bright spot when it comes to the labor market. And then where the continued reduction comes from is those government jobs. So we saw those weak as well. Now, the unemployment rate ticked lower on this, and that's because the labor force participation rate actually ticked higher. So we have a lower unemployment rate at 4.3%. This is good news for the Fed. The Fed can continue to remain on hold. They're not in a rush to have to cut interest rates. This is also counters some of the data we received last week, whether it was on the Challenger's jobs report or the job postings. Those things insinuated some further weakness here in the jobs data, but this data is not showing that. Now, a lot of noise around some of these indicators, so we won't take this 1 month as a trend. We'll continue to follow this data, but for now, we think it keeps the Fed on hold. There is no rush. Now, Friday, we'll get the inflation information, and again, markets might swing on that if that shows either a hotter number or a more tame number than what's anticipated. We saw quite a bit of volatility today in the equity markets. First, as I mentioned, with this data, we saw equities rise significantly, and then we saw them reverse that loss, and now it's been up and down all day, relatively muted from an equity standpoint. That's all we have today. If you want a history of our podcast, go to marketswithmegan.fm. Thank you.